Right, it's 10 o'clock in the morning where we are, so a very good Monday morning to each and every one of you watching, and cordially welcome to an online debate hosted by the EU's auditors on how the EU is doing in developing supplementary pensions. I hope you've all had a very restful weekend and are ready for what we hope to be a very engaging session with useful and actionable insights. Now, as you know, a few months ago at the European Court of Auditors, we have published a rather critical report on the development of supplementary pensions in the EU. So today, we are here to discuss the report and more broadly, the topic of supplementary pensions with key players in this field, all with the purpose of helping the EU run better. Now, I have the privilege of having with us today my fellow warm bodies in the studio. On my right, Mr. Mihails Kozlovs, who was the author of the special report that we published a few months ago, and is also the chair and host of today's session. So great to have you here, Mihails.
Thank you, Damian.
And great pleasure to have with us on my left also Kamila Lepkowska, who is our senior auditor and principal manager, also being very closely involved in this audit. So great to have you here, Kamila.
Thank you. Looking forward to the discussion.
But that's not all. Of course, we have with us also a wide array of experts in the pensions field. So let me just quickly go through their names. We have with us today Petra Hielkema. She's the chair of European Insurance and Occupational Pensions Authority. Franck Sébert, who is director at the European Commission in Brussels. Matti, Leppälä, who is the CEO of PensionsEurope, and Jacques van Dijken, who is the chairman of the same association, but also of Medical Pension Fund. Also with us today online will be Juraj Hrbatý, CEO of Finax.eu pension fund, otherwise known as the PEP. So this is one abbreviation you'll probably hear a lot of today, together with another one, which is EIOPA. You all know, of course, what both of them stand for, and that's why we're all here. And of course, last not least, also with us will be today Uldis Serbs, CEO of Finance Latvia Association. So we'll hear from national angle as well. Let me just remind all of you, today's session will be recorded, and a recording will be available afterwards. Now, in terms of the agenda, we will first hear from Mihails and Kamila here in the studio, and then indeed from all of our esteemed speakers. You will also have a chance to quiz them and have your say. For that, you can use either the slider tool. I think you can see it on your screen right now or very shortly. So please just scan the QR code and connect. And you can pose to us questions during the session. And we will definitely take at least those, the most voted ones. And when the time comes, you can also use the Teams functionality and just put the question to us yourself. Now, on this point, I would like to give the floor to Mihails Kozlovs. Maybe just one question to get us all going. Mihails?
Yes, welcome.
Pensions are a relatively recent phenomenon in comparison with human history. So, can we talk about them reaching pensionable age, or as a system, maybe they're still at infancy, grown up, mature age, or very old and on their way out?
Well, yeah, that's one of the topics that I think is in the air today and in general nowadays. On the one hand, I think we would like all to see the word pension achieving pension age, so that all of us enjoy a decent lifestyle at the retirement. On the other hand, we all hear about the pressures that we all have. And I think despite all the worries, there are also positive signs. I just read, recently that despite the number of workers who support pensioners is going down dramatically, the gains, the potential gains in productivity, for example, from introduction of AI, can help us all actually to withstand the pressure of public finances. So I think we are at this moment of time at a quite critical point, whereby on the other hand, we all feel the pressure on the public finances. National governments feel the pressure on the public finances, but there is certain hope that it's not only by painful reforms of the pension systems that we might get on, but also due to increases in productivity and improvements in technology we all use. So that's, I think, very briefly to warm up and to set the scene.
Very good. And now that we've opened this session, I believe that, Mihails, I think you have a special guest also here today who couldn't be with us, in fact, today, but I think he has an important message for us.
Yes, of course. First of all, dear participants, I am really delighted to welcome all of you here. And today we will discuss the state of play and challenges in building future-proof pension systems for the EU citizens. Notably, we will focus on the supplementary pension systems and the role the EU plays and can play in their development. We will draw on the findings of the recent report of the European Court of Auditors on the EU supplementary pension systems, and also, and notably, I would say, on the rich experience of our speakers and you, the audience. So feel free to engage through any means that are available today. And indeed, we have excellent speakers today, and I'm really thankful that they have agreed to participate at this session. So, as Damian said, we have a special guest who is not here with us, but who has kindly agreed to send us his video address. And the special guest is Finance Minister of Luxembourg, Mr. Gilles Roth. He is also, of course, member of the ECOFIN Council, where discussions about pensions and broader public finance take place and are actually made. And in Luxembourg, the topic has become very important lately because due to a projected increase of the pension budget by 2045, it is the largest increase in the EU, as you also will see later. Luxembourg has launched a public debate about pension reform. But let's not prolong anymore the introduction, and it's my pleasure to put on the screen a video address of Luxembourg Minister of Finance, Mr. Gilles Roth.
Good morning, Your Excellencies, esteemed colleagues, distinguished guests from across Europe. It is my great pleasure to open today's event of the European Court of Auditors, the ECA. As you know, the ECA is celebrating its 50th anniversary this year. Together with Franck and Henri, I had the privilege of speaking at the formal celebration in July. At the same time, I said that the ECA was a guardian of people's money. And the ECA continues to uphold its role as a vigilant auditor and catalyst for more effective EU policy implementation. Luxembourg is indeed honored to host the ECA and this important forum, in particular after its recent special report on developing supplementary pensions in the EU. As you know, the pension issue is also currently a major concern for us in Luxembourg. I am pleased that we were able to make significant progress here last week. But back to the special report. The report will be discussed today. Efforts to advance cross-border occupational pensions and the pan-European pension product, the PEP, will be discussed critically and constructively. This event, therefore, serves not simply as a roundtable, but as a pivotal moment for reflection, analysis, and action. Supplementary pensions can contribute to face the challenges that a rapidly aging population is posing. Pensions are more than retirement income. They are a cornerstone of personal security and social cohesion. They enable individuals to plan long-term while bolstering national fiscal resilience. And with the population over 65 expected to rise from 20% today to 30% by 2050, the strain on fiscal systems will only intensify if we fail to act. At the same time, pension savings also drive capital towards productive investments. This supports research, innovation, infrastructure, and thus growth across the EU. Luxembourg stands at the heart of Europe's financial ecosystem. With an unmatched expertise in cross-border fund distribution, fund administration, and regulatory excellence. The PEP was conceived to fill critical gaps, to enable mobile workers to retain pension savings, to foster competition, and to forge a true capital markets union. Yet today, its performance falls short of its potential. Uptake has been minimal, with just around 4,700 users and 11.5 million euros in savings, a tiny fraction of the 700 billion euro target by 2030. Critics point to obstacles such as fragmented national tax treatments and administrative burdens, or to limited incentives, awareness gaps, and fee caps. However, I'm hopeful that these challenges can be addressed. So let us emerge from today with renewed confidence and with a shared roadmap for the PEP as a vehicle for contributing to our capital markets union and savings and investment union goals. Let me close by reiterating, supplementary pensions are an important tool for individual security, economic sustainability, and social cohesion. Luxembourg is ready to play its part in making PEP a success story that is used across our union. I look forward to your discussions and invite all panelists and participants to join us with open minds and constructive proposals. Where there's a will, there's usually a way. That said, I wish you fruitful debates at your event here in Luxembourg. Thank you very much.
Thank you very much to Minister Roth for his participation through video. Unfortunately, he couldn't be with us here today, but it's absolutely great that we can have with us also EU policymakers. So we are auditors, we have with us also the executive power, we also have the fund industry, EU policymakers, and of course, almost 170 participants as we stand at the moment. So we're very thankful that everybody could take time today. Now, I think I would like to give the floor back to Mihails to tell us a little bit more about what we said actually in our report just a few months ago.
Yes, thank you, Damian, and first of all, thanks to Minister Roth and all the colleagues from the Ministry who has contributed to his address. And I think I just would like to quote what he said at the very end of his intervention, that the supplementary pensions are actually important tool, important element for stability of the pension systems. And we will try to dive deeper today into exactly the concept of supplementary pension systems. I will now briefly present the main findings and recommendations of our report that we have published, I think, sometime in May this year. And then, as Damian said, we will get into discussion and interaction with the speakers. Well, let me present the report along these four major blocks. Let me start with the bigger picture. The pension sustainability issue becomes a burning concern for policymakers and EU citizens alike. And for very good reasons, as we have heard from the Luxembourg Minister of Finance. With aging populations and despite various policy actions, public pension systems face increasing pressures. Indeed, the aggregate replacement ratio has been declining in some member states to as low as 40%. And this is still not the floor. According to the latest data, 1 in 5 people over the age of 65 are at risk of poverty in the Union. And these colleagues are 18.5 million citizens. 18.5, I think it's important to speak in absolute numbers in this context. Therefore, the supplementary pension solutions play a crucial role, not just for individuals, but for a broader economy as well. For citizens, it is important also to be able to navigate these complicated concepts in order to plan for retirement. To illustrate what I just said, one of the slides shows the public pension spending is expected to rise in 16 member states by 2070. And you see that Luxembourg, again, is one of them. As I said in my introduction, the old age dependency ratio will rise sharply also by around 2070 from 3 working age persons for every person about 65 years to less than 2. And the aggregate replacement ratio in 12 EU member states in 2024, for example, pensions accounted for less than half of the median earnings among people towards the end of their working lives. So pension costs, therefore, will be the main driver of the rise in aging-related fiscal costs. In some member states, the pressure on national budget is reduced by the private occupational pensions. And you see that in the EU there are a handful of member states with sizable occupational pensions market. In the context of the Capital Markets Union and investment gap in the European Union, the issues underlined in the Letter report, the EU countries where households invest a relatively low share of assets in deposit and currency, these are Denmark, Netherlands, and Sweden. These countries are also those with large mandatory funded systems. And in these countries, the household portfolios are more similar to those in the United States, which is and has the most deepest and liquid financial markets in the world at this stage. The role of the European Union is relatively limited. Yet clearly the EU has competence in several important areas, as I note on the slide, in the cross-border mobility, consumer protection, and some other areas where the EU legislates or exerts some soft power, soft pressure through various instruments of multilateral policy making. In this audit, we therefore have focused on responsibilities related to supplementary pensions that are within the remit of the European Union, notably within the remit of the European Commission and the European Insurance and Occupational Pensions Authority, EIOPA. I will call it EIOPA in the rest of my presentation. So this means that our focus was on occupational pensions governed by the EIOPA directive and the Pan-European Personal Pension Product, or PEP, regulation. In terms of methodology, this is just to show that our methodology was quite rigorous, thanks to the team of auditors represented by Camilla. And we conducted a really broad-based analysis of data and also of all relevant stakeholders. Let me now come to our main findings. So, overall, we found that despite the EU action, the current and potential contribution of supplementary pensions to adequate pension income for the EU citizens is below expectations. We have identified 3 main areas driving this overall conclusion. First of all, the lacking effectiveness of the EU regulation in strengthening the single market in supplementary pensions, notably for pan-European pension products. Gaps in supervision of the existing market players. And thirdly, insufficient protection and information for current and future pensioners. As a starting point, we observed that the single market for supplementary pensions is very shallow. Yes, the EIOPs manage now around 2.8 trillion euros in assets and serve around 47 million workers and pensioners. However, due to historical and structural reasons, occupational pensions are generally concentrated in a few member states, with no signs of development of this segment of pension system in other member states. Despite the existence of the EU regulation that aims to promote cross-border activity of the EIOPs, it remains marginal compared to the size of the market. And similarly, with PEP, that was established in 2019 by the EU regulation, it has not been successful until now because currently there are only 2 products on the market, and one of them was created very recently, therefore it does not feature in our report. Here you see several slides, several pictures from our report that basically show you what I said from the statistical point of view. I will not spend much time here, but for example, if you look at the cross-border IOPS data, if the market functioned well, you would not see any blank space in the inner part of the circle. So it would all be covered by arrows going from one member state to another. And as you see, this is not the case, so the potential is still there. The EU regulation clearly did not achieve its objective, neither with regard to IOPS nor to PEP. Our report highlights, however, that the EU action alone within the current treaty framework cannot make a major difference in terms of fostering single market in the area of supplementary pensions. And I think this is an important point for us to discuss in the view of forthcoming Commission's proposals. The key hampering factor for cross-border operation of the existing IOPS and the growth of PEP remain the differences in social and labor laws. Also, taxation plays a crucial role. All these factors remain under the responsibility of the member states, and the appetite to create a level playing field is relatively low. Now, let me come to the supervision of IOPS. Even if the single market in this field is not thriving, as I've shown, effective supervision remains important, as many Europeans in several member states rely on IOPS. The major gaps in terms of supervisory convergence are actually a poor reflection of specific risks related to the ongoing shift from defined benefit to defined contribution pension schemes, and the lack of regular supervisory reporting. In the same vein, regulatory arbitrage risk is also present, and in our view, as we have shown in the report, it is insufficiently addressed as yet. Enhancing supervisory convergence is one of the main tasks of EIOPA, and the agency makes welcome efforts in this direction. However, the use of EIOPA's tools is limited due to 2 main reasons. The focus on the insurance market in line with EIOPA mandate, so lack of resources in a way, but also low implementation of EIOPA outputs, recommendations by the national competent authorities in member states, and this, of course, has to do with the current governance structure. Importantly, EIOPA reports could bring more transparency as to information about the returns. This next slide is just to illustrate the use of main legal instruments by EIOPA, and we have observed that the use of enforceable tools was relatively limited. And this, I think, also has to do with the governance structure, as I mentioned, and the chance that actually the in many cases, welcome recommendations and outputs of EIOPA work would be implemented at the national level. Finally, let me touch upon transparency about pension rights, which is essential for citizens as they approach retirement, especially if the pension rights are accrued cross-border. The welcome measures to improve transparency foreseen already in the Capital Markets Union strategy, such as pension dashboards and tracking systems, came, unfortunately, to little effect. On a more technical level, EIOPA worked to improve transparency on occupational pension schemes, but gaps remain. especially when it comes to clearly disclosing the costs and performance of funds. For example, EIOPA itself doesn't publish data on the IORP's past performance. However, according to some sources that we managed to find, and this is or was apparently the sole available source, the medium and long-term returns of occupational pensions in the EU are relatively modest, and they become positive over a very long holding period. So our recommendations actually stem from the observations, and they assume no change in division of responsibilities between the EU and member states at this stage. So we have come up with 6 main recommendations. First of all, we invited the Commission to decide, to put it very simple, to decide what to do with the PEP, Pan-European Pension Product, given very low uptake and the size of the market far below expectations. Strengthen the supervisory framework for the existing IORPs, and you have more details in this respect in the report itself. Perhaps, number 3, perhaps empower the EIOPA a bit more to render its activities more effective and give them more impact on the ground. Number 4, to focus on systemic risks that really matter, because we found that in the previous stress tests, some of the risks perhaps were, well, they were relevant, but perhaps there were risks that could be considered more relevant for this specific market. Number 5, as I said, improve transparency on IORP's cost and returns. This is very important for the citizens, of course, to understand whether it's worthwhile putting their money in this from the point of view of return. And last but not the least, to increase transparency on pensions by making progress on pension tracking systems and dashboards. And this is the area, I think, where the EU, for the time being, has quite a lot of say, and perhaps these initiatives could be continued and also brought to fruition as soon as possible. So I will stop here. Thank you very much for your attention. And Damian, I think back to you for some intermediate.
Yes. Thank you very much for this rather comprehensive overview of our findings, insights, recommendations from May 2025. So still pretty fresh and in the context of the current developments. Now we are ready to take on board any of your comments, questions. We planned about 10 minutes for that. We can use the Slido, which you can see on your screens. Just again, scan the QR code and connect, put the question to us in writing or vote on it, or you can just raise your hand digitally in Teams and we'll give you the floor so you can do this yourself. There are already a couple of questions in the Slido, so I'll just go ahead with those, waiting for people to encourage to ask us a question. And I believe that we have now close to 200 participants already, which is absolutely great. Now, the first question goes, how sustainable is the first pillar pay-as-you-go pension system in the EU? So quite straightforward.
Yes, thanks. That's a very relevant question. In the report, of course, we didn't assess the sustainability of the first pillar, because the first pillar per se is in the competence of member states. We could have looked at it, of course, and maybe we will in the years to come from the point of view of fiscal sustainability of member states' budget, which is, of course, a matter of common concern for all member states. But for the time being, I think we touched upon pay-as-you-go from the point of view of adequacy of pensions, whereby we have seen that if things go unchanged with demographic changes, we can hardly hope to see adequate pensions, and maybe no pensions at all, no decent pensions at all in the already quite foreseeable future. So if I look at my children, I tell them, look, don't count on pensions, don't count on pension work to create good asset base for yourself. So this is how I would answer this question.
Very good. Thank you very much, Mihails. Camilla, would you like to add anything to that?
Well, yeah, I will start with a disclaimer that our report focuses on supplementary pensions, and we are here at the auditors not to replace the job of economists or demographers. But still, of course, we refer to this important context in this report. We refer to important documents that the Commission produces, the aging report in particular. So this is a place to look if you want to have some details. But still, on substance, well, the situation is very, very diversified across the member states. In the aging report, we see that the expenditure will not increase dramatically in the EU on average by 2070, which is the perspective that they take into account. Still, in some member states, in Luxembourg in particular, as the Minister of Finance mentioned, the increase is quite substantial by 8 percentage points of the GDP, which is really like a huge amount of money. In some countries, much less. In some countries, the public pension expenditure will even decrease. But that we have to keep in mind comes at the expense of the replacement ratio. And to give an example, in the country that is closest to my heart, in Poland, the replacement rate may even drop from 58 in 2022 to about 27% in 2050. So that's a huge drop, and similar numbers we may see in other member states. But I want to stress that the picture is very diversified, and the demographic trends, they differ from country to country. So it's difficult to give a one-fits-all answer for the EU as a whole.
Okay, well, very good. We are not having crystal ball. We're not demographers, economists. Well, we are economists, but we're not economy planning. We are auditors, so we're here to have a very sound debate. And the next question will be asked live. I believe Joe Pilger from Ernst & Young has raised her hand, or his hand. I think Joe is already working with the global pension trends, so I think we're looking forward to that. Joe?
Thanks very much. Number one, excellent report. I'm no longer with Ernst & Young, so this is my personal opinion. I retired about a year ago. But to me, probably two-fold question. One is, have you guys looked at other systems around the world? What drives their success? And I think if I personally jump a little bit to a conclusion here, is there is no voluntary system anywhere around the world that has been successful. So I think a fundamental tenet of the mechanism, in my view, would be helpful. But the true question here is that I want to raise is, having worked for 30 years across the world and across Europe in this space, is can you have you looked into what I call conflicts of interest? And what I mean by conflicts of interest, political conflicts of interest. Why would I give up my autonomy in XYZ country? And full disclosure, I carry a German passport still, even though I live overseas. But have you looked at the conflicts of interest of providers? Why would I let someone from XYZ country all of a sudden compete in my market that is currently my market that I dominate? So have you looked into the conflict of interest element that in my view is one of the overarching elements next to customer behavior?
Well, thank you very much, Joe. I think we can answer this question. Mihails, yes. Conflict of interest, have we looked at that?
Yes, I will start probably. Well, I think we touched upon the conflict of interest in several aspects of, in the report, maybe indirectly. First of all, where we saw this, it is in the governance framework, whereby I mentioned that many, in our view and the view of the Commission, also welcome ideas of EIOPA coming from its work on supplementary pension systems were not taken up by its governing bodies, by the national competent authorities. So that's already a reflection of also what you said, and I think this is something that we see not only in this report, but also in some other reports. Therefore, broader governance issues are also one of the elements in this discussion here. In terms of in terms of the providers, I think it comes maybe more to protectionism, protection of the market. And again, we see this not only in the supplementary pension funds, but also in the banking area, and some other areas. So that's why, in a way, we underlined several times, and I also underlined in my expose, so to say, that we base ourselves that there would be no changes in the fundamental framework governing these issues. So the responsibilities will still be shared and more skewed, I would say, even in the field of pensions, to member states. And we saw no appetite to make any changes in this respect. So these conflicts of interest, you may call them conflict of interest, you may call them protectionism, but they will be with us perhaps for some time. On your first question, I think what you mean is whether the prerequisite to build successful supplementary pension is a mandatory legislation to enroll people. And I think this is something that we also saw. We didn't come as far as to recommend this, because again, this is not our area of responsibility. I hope we will hear from the Commission as we go on. But of course, we see that the markets that are now successful, it's not only about maybe mandatory, but it's also about traditions that go hundreds of years ago in specific countries, like for example, the Netherlands. Yeah, if you compare Netherlands with, for example, any country in Central and Eastern Europe, the traditions and the structure of the economy traditionally for hundreds of years are somewhat different. So of course you cannot expect to develop in the same pace, but some inducement, and we will discuss later how this could come to member states from the EU, could be a way forward. That's from my side. Probably, I know, Camilla, if you have any point on any of these issues, would be. Yeah. Because you dug deeper into this, so probably you know some.
Yes, indeed. A slightly more technical reference as concerning the conflict of interest. So when we talked in the second part of the report about supervisory convergence, there we saw a number of gaps in the supervisory framework, and conflict of interest indeed is one of the gaps that we identified. Here we mean, though, a conflict of interest regarding the outsourcing phenomenon that is growing in the business, and that's a potential conflict of interest between the EIOPs and their service providers. So this is also about a conflict of interest, probably at a slightly different level. But then, sort of closer to what you were talking, we talk also a lot about the risk of regulatory arbitrage, meaning this jurisdiction shopping when an EIOP is only registered in one member state, not only to do actual business there, but really but just to use the maybe weaker supervisory requirement in that country. That is something that we see clearly a risk of, and maybe even signs of this happening. And we think that this should be taken care in future amendments of the regulations.
Well, very good. Thank you both, Mihails and Camilla, and also Joe for posing a question live, and also for the question that was put anonymously on Slido. There are a number of questions on the Slido and they keep coming as we speak, and we will try to take as many of those as we can later on. But for the time being, as we want this to be a fast-paced and also sticking to time, so my role is also be a time policeman, I suggest that we move forward. Mihails, you have an esteemed lineup of experts with you today, and I think you would like to quiz them also a little bit yourself.
Yes, Damian. Thanks, and thanks also for posing all these questions. I think we will come to them sooner or later, and if we don't, I think they would be touched upon in any way. Now we come to our distinguished panel of experts. And first of all, welcome to Petra Hielkema from EIOPA. Thank you, first of all, for finding time and joining us. I know it wasn't easy. And I hope you have brought also to us some fresh ideas from the Eurofee conference last week, where basically these issues normally discussed. Thanks also to EIOPA, because as I mentioned in my introduction, you are doing an overall good job in quite difficult circumstances. So I have 2 questions to you that I would like you to address in more or less 5 minutes. I know it's a challenge, but I know you can speak in a concise way. First of all, but very briefly, what are your thoughts about the report itself and the issues we raised there? Have we missed anything important that we could have underlined? And second, perhaps more importantly, you have been calling for an urgent reform of the European pension system, and in this regard, what do you see as a gap and or hindrance in the current EU framework for non-state pension products? And here I mean design, comprehensiveness, regulation, and supervision, and all these, of course, given the EU level of competence in the free movement of people, capital, and in the EU roles in the sustainability of national public finances. So quite a lot on your plate, but I know you have answers ready to go, to share. So please, Petra.
Yeah, so good morning, everyone, and thank you for having me this morning. Thank you also to Eka for choosing a very important topic and a very timely topic to discuss, but also to research on. So we welcome the special report, and all in all, we have no fundamental objections to the conclusions that were drawn. EU action has not been as effective as it could be in strengthening occupational pension uptake and establishing a pan-European personal pension product either. We've seen that the PEP regulation fostered very little cross-border uptake thus far, and also in the internal market, the cross-border market for EIOPs remains insufficiently developed. Now, that being said, and in the context of the Savings and Investment Union, we have submitted several proposals to adapt the existing EIOPA directive and also to look again at the PEP regulation and to enhance the regulatory and supervisory framework with a goal to boost supplementary pension uptake, to reduce the pension gap, and to promote pan-European pension products and creating scale. Now, what is important here is that the ultimate goal is to help people live decently in their retirement. The numbers show that at least 20% of Europeans are at risk of not being able to do that. And for women, that risk is 35% higher. So we really have an issue there. And it's been there for a while. And EIOPA has been saying this for a while. We're very happy that pensions is now so much on the agenda of the European Commission and of the other institutions. At the same time, we recognize that the reason it's there is because we need more investments. And yes, if people save differently, there will be more investments. And it could actually benefit both. It could result in better pensions, less people living in poverty in retirement, and at the same time more capital available to invest in the transition that is so much needed in the EU and in our safety. But we need to keep in mind that whenever that investment is happening, ultimately it has to be resulting in a good pension. Now, what we think going forward is that we should not repeal the PEP regulation. There's a lot in there that is still very beneficial and that could work, but there's several things we could do to make it better, and dropping the cost gap, making it optional to be cross-border, and at the same time, do value for money, deliver good results, do it digital, do it simple, and if it's really simple, the basic PEP, let's call it Euro pension, and let's make sure that people, if they get a Euro pension, it's digital, it's simple, it's straightforward, it delivers value for money. So it's vital that we do this and that we bring these results. It's vital that once people start saving, we somehow scale the capital that they save. But ultimately, it's important that however that capital then is invested, and that is for those who do the investment, that's not for the supervisor, it results in a good return, value for money for those who need it when they retire. And I'll stop there.
Thank you very much. I think you brought several important issues. One of them, this gender gap, of course. Maybe if I may, just to come very quickly to press you a bit more. You suggested some ideas going forward with PEP. Do you mean PEP as a kind of 28th pension regime in the EU? Because apparently it's very difficult to ensure a level playing field for this product in the EU currently. And if you do, then of course in the past we've had similar initiatives in some other policy areas, and they did not succeed until now. So why are you so, or let's say, are you optimistic in this respect at all?
I think the 28 regime is part of the advice, but there's a lot more in there. I think we have really an urgency, not only to make sure that we have indeed capital for the transition and for our defense, but we also really need to get started on pensions. We have a few northwest of Europe that has full developed pillar 1, 2, and 3, but we have a big part of EU that is leaning on state pensions that long term is not sustainable, that will ultimately also impact the rest of Europe. We need to work on that. The starting point of pensions in every member state is social and labor law. And incentives to make people save is taxation. Taxation is not a mandate of the EU. So I think what you see us do in our advice that we sent, and I can really recommend to read it. I think many people over summer did a good job. The starting point is recognizing that and then seeing how can we work from there. And this is why, yes, there is a 28 regime proposal in the PEP proposal, but we also say, you could also say a Euro pensions label. That products that are developed in a market that fits in that market, it could be incentivized through taxation in a particular market in EU, so in one of the member states, but it has the identical features that I just alluded to. So digital, easy pension product, so it pays out in retirement. It has also a decumulation phase. And moreover, it comes with a sense of this is a good product, you can trust this product and send trust. Now that could be labeled in national markets and we could monitor that. That could be a start. Yes, you could also move to a 28 regime. That is very much for the EU institutions to decide on. But I do agree that we have seen before that is not always a success. And so I would not bet on one horse. I would really think holistically, ultimately what we want is that people start saving in the second pillar and in the third pillar. Second pillar, automatic enrollment is essential, but allowing for that automatic enrollment to not only happen possibly in EIOPS, but if preferred, could also happen in a Euro pension in the third pillar. That in itself could help people to start saving. And again, ultimately, tax incentives help, but they are very much with the national competent authorities.
Thank you. Thank you very much, Petra. Thank you very much. At this stage, I will leave you with these thoughts from EIOPA, very, very interesting ideas, I think. Now, let's move to the Commission, and it's my pleasure to welcome here representative of the Commission, Mr. Franck Sébert, from DG Employment. The Commission, as we all know, has the right of initiative, and exactly as we have heard already up till now, this initiative is exactly what apparently we all need at this stage. In replies to our report, that are also published, by the way, on our homepage, the Commission has broadly accepted our recommendations. So with you, I would like perhaps to focus a bit on the future. Some speakers already said that the expectations and ambitions until now in the field of supplementary pensions have not become a reality. And the Commission has come up with the new savings and investment strategy some time ago. So for you, the main question, I think, if I may, would be what policy directions or specific and importantly realistic actions does the Commission have in mind as far as reforms of EIOPS and PEP frameworks are concerned?
Thank you very much, Mr. Kozlovs, and Congratulations really to Camilla and the audit team. As you said, from the Commission and particularly the employment perspective, we would like to thank very much the court for this thorough and insightful report, which comes at a very right time, actually, since you know that the Commission is planning to adopt the pension package as part of the Saving and Investment Union at the end of this year. As a representative from DG Employment, I would like to recall an important principle, which is before answering your detailed question, saying that ensuring that all Europeans have now and in the future access to adequate, sustainable and safe pensions is not just a matter of financial or economic policy. We consider this is a core principle of the European Pillar of Social Rights, and in particular its Principle 15. Looking at the fierce public debate in the member states across Europe regarding the reforms of the pension system, we see clearly that this is a key issue for the functioning of our democratic societies. And in that regard, we share very much the ECHA assessment in the report for this policy context. We've heard already today about the challenge shared by all member states about the demographic aging. I just wanted to quote one figure. In the next 45 years, the old age dependency ratio, that is to say the share of people aged 65 compared to the number of people in working age, will increase from 38 to 59%. This shows the huge challenges on the adequacy and sustainability of our public pension schemes, the need for social protection in old age, and we heard this figure of 1 out of 5 people over 65 being at risk of poverty, but also with an impact on the EU competitiveness and social cohesion. And in that regard, the Draghi report shared its views about the huge 800 billion a year which are needed to address all the needs of the economy, not to speak about the challenge of defense. All of this policy context, in this policy context, the Commission presented its Savings and Investment Union strategy in March last. The strategy aims to create better financial opportunities for citizens while enhancing our financial system's capability to connect savings with productive investments. That's very much what we are discussing today. And therefore, we share the views of ECHA in its report on the importance of these supplementary pensions, and that member states should take a longer-term and holistic approach to developing such multi-pillar pension systems. From DG Employment perspectives, of course, I want to stress that social partners are crucial in this process. So now, what are we concretely proposing? I'm not able now to disclose the work that DG FISMA with Commissioner Albuquerque is putting together to make this proposal for the pension package by the end of the year, but I can share with you a number of ideas and way forwards on the finding. The current legal frameworks for providing supplementary pensions via so-called institutions for occupational retirement provisions and through the PEP, the Pan-European Personal Pension Product, have not been very effective. We all share the finding of the court. And efforts to boost occupational and personal pensions on a cross-border basis is also largely unsuccessful at this point. Several challenges have stood in the way. Pension providers are often too small, markets too fragmented, regulations can be restrictive, fees and costs are high due to insufficient scale, and many workers and employers are not familiar with these providers and pension products. As a result, the Commission, led by DG FISMA, is reviewing the existing framework for occupational and personal pensions, with the aim of increasing participation in supplementary pensions to ensure adequate income in retirement. And of course, also improving the capacity of these pension funds to direct household savings into investment and productive and innovative investments. The Commission is considering the ECHA special report to contribute to this debate. We've taken already its findings and recommendations into the targeted consultations conducted up to end August. And we also take account of the technical advice and input from EIOPA for both the review of the Occupational Retirement Directive and the Personal Pension Product. Concerning the personal pension products, the Commission will aim to relaunch a simplified, cost-efficient, digitally friendly version of this PEP that is more attractive to providers, while maintaining at the same time a very strong consumer protection. The scalability of the product is essential, but the actual avenues for achieving it is still needs to be fully explored. As far as the occupational retirement provisions is concerned, the Commission is considering several possible policy measures. These include to facilitate the scaling up of supplementary pension funds, strengthen the risk management practices as identified by the audit, enable greater asset diversification, and enhance the protection of members and beneficiaries by the introduction of a specific duty of care. We are also assessing whether the scope of the directive can be adjusted to better capture the diversity of the EU supplementary pension landscape as presented by Mr. Kozlovs and Camilla today. So these are the actions that the Commission has in mind in view of the pension package of the Saving and Investment Union. Thank you.
Thank you very much, Mr. Sébert, for these ideas. Although we are slightly behind the time, I still behind our schedule. I just wanted to put to you one more specific question, and if you could answer as brief as possible. I mentioned also the pension dashboards and pension tracker systems as important elements for the citizens to improve their awareness, and therefore when you are aware, you also, of course, questioning your government, well, what will be my pension in 20, 30 years, therefore putting pressure and inducing action. So how do you see really, going forward in implementing these important actions that were already envisaged in CMU, but as I said, also did not come to effect until now, despite quite a serious action by the institution. So if you could please very briefly comment on this.
Thank you very much indeed. It was a point I wanted to come on at the end of the process, but from the DG Employment perspective, we fully follow your sixth recommendation, which is about pension tracking systems and dashboards, because we agree that the citizens can effectively plan for their retirement only if they have clear and accessible comprehensive overview of their future pension entitlements. You are quite right, Mr. Kozlovs, on this. Transparency is fundamental. That's why the Commission is working together with ECFIN about recommendations on the use and best practices of national pension tracking systems and pensions. We will recommend to develop such tools, and we are also supporting the work by pension stakeholders to roll out what we call the European Tracking Service for Pensions, ETS. The idea is to connect it at least with 5 to 7 national pension tracking systems by 2029 to ensure better transparency and develop ETS into a European hub of pension communication. So yes, we are fully with you. Transparency is crucial, and DG Employment is working on that and will make further recommendations by the end of this year.
Thank you very much. So we're looking forward to these proposals, really, and thanks for enlightening us as to what we may expect towards the end of the year. Now it's time to give the floor to Mr. Matti Leppälä, Secretary General and CEO of PensionsEurope. Actually, this is the organization that works to promote workplace and other types of funded pensions across Europe. We also met with you during the audit phase, And again, two questions to you. First of all, about our findings, and maybe focus if we missed anything that we should have said. This is one thing. And second question, more substantial perhaps, given that in most EU countries, including the region of Central and Eastern Europe, a private pensions market, while growing, of course, it's still very limited. What role the EU should play to develop it further and quicker, most importantly, quicker? Thank you.
Thank you, and thank you for having me participate in this event, and thank you also for engaging with us while you were drafting the report. I think it was very good discussion we had on the pension landscape and the challenges that are there. And I would echo what the previous speaker said about the fact that this report is really timely, but it's also, I would say, realistic assessment, and confirms many things that I think have been clear for a number of years, meaning that the EU actions have this far had limited effect in strengthening occupational pensions across Europe. And of course, it has not made the PEP has not been a success this far. But we also heard that from the Commission already that this report will have an impact on the actions of the European Union going forward, and I think that is really very beneficial and important. In occupational pensions, I think the fact is that EU and EU law is not the real object for success. I mean, the obstacle for success, but the fundamental differences in national social and labor laws. When we're talking about occupational pensions, it is very much about social and labor law, and that remains national, and that poses a real problem for the European framework. The cross-border pensions have not been a success, very much for this reason. And what I think is that the EU should focus on supporting national occupational second pillar pensions. They are, of course, very diverse across Europe, but the EU should support those and not try to engineer an internal market that with these realities cannot fully function. So pensions are not products, occupational pensions are not products sold in the internal market. They are first and foremost social contracts and very much national. And I think it is really good to see that this has been recognized in the report, and it has been recognized also more openly and clearly also by the European Commission and other relevant actors. I think this realization of the reality is important when we try to find meaningful ways to go forward. And then this also ties with the fact that more often now pensions are framed as consumer products and then introducing with that the consumer protection framework, which is very different than the national social and labor law frameworks, and not really compatible with many issues that are important for occupational pensions. And then this approach of having retail investment approach is not the right one. I would say occupational pensions are not retail investment products. They are collective, social, not-for-profit schemes run by social partners, and that is important. It is challenging for European Union, but it is important to realize this and to respect this. On PEP, that is, I mean, Petra, you already said many important things, and I think that those will be relevant. It is clear that it has failed, and it's also important that we have recognized that it has failed. The report also points out that the impact assessments were not considered as they should have. I think that is also important going forward, that we take realistically the impact assessments and do things that we think that actually work Pensions Europe has been supportive of the PEP from the outset, but a PEP that actually works. And we have now a PEP that does not work in the way that we intended. So we don't have to make PEP work at any cost, but I'm sure we need to improve PEP. And I think the right way to do it now is to have targeted supply side reforms on the fee cap, on transparency requirements, on investment issues, on the advice rules. And I think there will be many proposals that will be debated in the upcoming months. On this 28 regime, where the PEP would be also a workplace product, I think we should be very cautious. It should definitely not substitute a well-established national pensions in the occupational pension sphere. So that is something that we really have to be careful with. EU needs to help with practical tools. So the pension dashboards, tracking systems, financial literacy, which are highlighted in the report and also by the Commission, those are important. And also, of course, the role of the Commission, DG Employment Social, together with DG ECFIN, as you have both worked already for many years on looking at the adequacy and sustainability of pension systems together with the member states. I think that is really important that based on this work, we come up with dashboards that can give people a realistic view on what their pension expected retirement income will be. And based on this, people can make then decisions and policymakers can make better decisions on what they actually need to do. So the information given with this envisaged dashboards, I think, is really important. And of course, the tracking systems giving individuals then information about their own pension rights, those are important. And of course, as mentioned, the European Tracking Service is an important initiative in addition to the national tracking services. On the role, EOP's role in developing pensions in the Central Eastern European area and other countries as well. Again, as mentioned, pensions are primarily a national competence and they reflect different traditions in social labor law and tax policies. And so EU should support these, but not prescribe. And I think that is what is going to be the future. One issue that is in the report, which I think is really important and has been underused, is the power of the European policy within the European semester and other economic policy tools that can be used in pension policy. In my view, these European policies, country-specific recommendations, have done a great deal in changing the first pillar social security pension systems to be much more sustainable financially. I think this is a great success in many ways, but very little has this policy tool been used in supplementary pensions. Only a few recommendations have dealt with supplementary pensions, and I think there European Union could do much more than has been done this far. And that is something that can be used immediately within this European semester cycle. And I think there should be more ambition to use the country-specific recommendations in supplementary pensions as well. And also I would call for the European Commission to be stronger in actions if and when the member states then, for political reasons, do introduce adverse developments, pulling back supplementary pensions, which has happened in many cases. So, of course, it's a member state competence, but what I do think is that Europe should not stand idly by what if and when member states then dismantle pensions that are important for the retirement income and the well-being of their citizens. EU can be supportive in good practices. It can encourage second pillar developments. It can provide practical tools, and of course, long-term investments are important for the European economy, broad the European financial markets, but also locally and for the local financial markets. And what is also important is that EU avoids burdening smaller and emerging markets with too complex and costly rules, which may be designed for larger systems. We are faced with this horizontal regulation that encompasses basically everybody, from big banks to really small emerging pension funds. And we really have to see what are rules that actually function, what is the role of proportionality. It's not easy in many issues. It's not easy to say what does proportionality mean, but it is important to try to take that into consideration in every regulation that we do. And so in the CEE region, which is of course in many ways, it's very diverse, but it's in many ways underdeveloped in supplementary pensions. I think EU needs to encourage at least gradual expansion of pensions and support national reforms. I mean, it's not going to be easy. It's not going to happen really quickly, but it has to start. It's never too late to start. The longer we delay starting in this, the more difficult it gets. Thank you.
Thank you very much, Matti. I will not come back to you with additional question because you have exhausted actually what I wanted to ask, because I wanted to press you really on how exactly the EU can support and what are the policy tools that could be better used. And I think you already covered and mentioned the EU semester and perhaps also the conditionality in using the EU funds that we have now seen appearing quite prominent in the recent Commission's proposal on the next EU budget. Now it's time to hear from practitioners in the sector, and we have the pleasure to have with us here Mr. Jacques van Dijken, Director, Chairman of PensionsEurope, member of the Board of Pensioenfederatie, and also CEO of SPMS, which is a pension fund for medical consultants in the Netherlands. I already mentioned that the supplementary pension market in the Netherlands is one of the best developed in Europe, certainly, and also in the world. And the question to you would be, what if you were now given, carte blanche, what would you do if you were asked to achieve the same level for the whole EU, or at least to move in this direction? So this is the first question. And the second question on cross-border activities of EIOPS. That was one of the main objectives of the EU legislation. But still, these cross-border movements, as we have shown in the report, are quite limited and concentrated among few member states. And the question is, should it be a bigger concern for the whole union? So what immediately could be done to really kind of unlock this potential and expand these cross-border movements beyond several member states, which is the case now? So please, 5-6 minutes to you.
Yeah, Mr. Kozlovs, thank you very much for having me. And I'm taking a look at the time. I try to support you in your endeavors to keep on time. I think a lot of valuable messages have been shared by Petra and by the CEO of PensionsEurope, Matti, the previous speaker. But let me reiterate some of the message, and I will do it fast. I welcome the report of the European Court of Auditors. It's obviously a very serious report, and the court has spent a lot of time to understand the European policy in the area of funded pensions. Important work. And I understand you have also worked with PensionsEurope and other European and national stakeholders, which is a very good thing, I think. There are a lot of valuable messages in reports, so my compliments. At the same time, the analysis is also, to a certain extent, somewhat limited, but let's start with the messages that I do like. And the main conclusion is that the EU policy has not yet been not yet been successful at stimulating the uptake of funded pensions to the extent that we would have all hoped for, both second and in both the second and the third pillar. And this is somewhat of a sobering conclusion. If you consider that aging is a ticking time bomb that slowly puts fiscal pressure on member states increasingly, we agree that we need to do something about this. So this is probably the most important reflection from my side. Second, the Court of Auditors points out something that I think that has not yet received so much attention, and that is that the EU has not used its full set of powers to promote funded and occupational pensions as it could have. PEP and IO2 provide a framework for pension schemes and pension products, but they do nothing to ensure their uptake. And that is, I think, the real nature of the problem. Legislation can bring the horse to the water, but can't make it drink, as the saying goes. However, there are things that can be done at the national level to make the horse drink. This creeping crisis is worrying enough that the EU should use all the tools in the toolkit to nudge its member states. The court finds that the European Commission essentially has not used the economic governance model to give a push towards more funded pensions. The same applies to the use of conditionality in the corona funds that have been distributed. We agree with the court that we can use these tools more going forward. A bit more critical. I also mentioned that the report to a certain extent is somewhat limited. That is because it takes the policy objectives that have been stated by the Commission as granted. Those are the starting points of the audit. This is probably what in the mandate of the court and how you do your work, but would have been the answer if you would have taken objectives as the starting point. Would you have got different answers? And the answer is probably yes. So what are these objectives? And the one is the cross-border activities. This should be a means to an end, and to my humble opinion, not an objective in itself. I come to speak of it later a bit more. The second is supervisory convergence. This is an important objective of the Commission and the European supervisors. And it makes sense that if I open a bank account in Lithuania or France or the Netherlands, I should be able to trust that the level of protection is the same. But a bank account is roughly the same thing in all those three countries. In occupational pensions, as has been stressed before by previous speakers, we see a huge divergence of pension schemes, DB versus DC, and many types of hybrids. The Netherlands is an example of that in the new pension system, with or without guarantees, social partners or for profit, cost borne by the employer or by the participant, communicating through a pension tracking system or not. These differences require different supervisory approaches, in my honest opinion. And the third thing is information to members. The objective of the rules is to provide as much detailed information as possible to members and beneficiaries. This is resulting in a very detailed pension benefit statement. And now the court and EIOPA are calling for even more information to be added. This is not a bad thing. But the objective should really be not to provide detailed information, but that information is understood and used. That objective requires a different approach of communicating. And in the Netherlands, this is a very relevant theme as we migrate from the one cipher, basically DB to DC. And we communicate to members pieces of information of over 15 pages. This is really problematic. To conclude, the report makes a number of good observations what the EU can do better, but if you want a comprehensive view of EU pension policy, you also had to include their objectives. And then quickly on your second question. The vast majority of assets are managed by paritarian IROPs. I firmly believe, as Matti indicated, in the strengths of these paritarian structures managed by social partners. I am employed by the pension fund of medical specialists in the Netherlands. They want me to give them good returns against acceptable risk, good communication, and supporting decision making. They definitely do not want me to go and enroll medical specialists in Belgium or Germany. Traditional EIOPs have no interest in serving individuals outside their sector and member states. Also, this is a bit of a sobering conclusion, but I really think this is what it is. Secondly, the traditional rationale for cross-border activity is increased economies of scale. This could lead to lower cost and better access to alternative investment is the argument. However, we see that pension funds that do operate on a cross-border basis only benefit marginally from economies of scale. Labor law and tax law will remain national, and therefore pension administration and communication will still be conducted at the national level. So the rationale for cross-border activity is much smaller in occupational pensions than for other types of products. Asset management does see clear economies of scale, but that is outsourced. So currently, that can already happen on a cross-border basis. And taking a look at my employer, SPMS, we deliver a full package, and I think SPMS is a relatively successful pension fund, delivering the service, overall service, for roughly 50 basis points per annum.
Thank you. Thank you very much. I think you brought really a practitioner's perspective and also shifted a bit the focus on these objectives or incentive. I think you made a couple of interesting points about the fact that, for example, EIOPs are a national, in your view, national phenomenon, and ultimately cross-border movements are not just for cross-border, but to have some additional returns, additional profits, so it's more financial. And if it's not the case, due to all the obstacles that some other colleagues mentioned, and of course the motivation is quite low. But we might come to this in our Q&A. We need to press on now with another practitioner, and here I would like to introduce Mr. Juraj Hrbatý, CEO of Finax.eu. During the time of the audit, that was the only PEP operating. And thanks indeed for joining us today. Again, two questions to you. At the moment, your company is basically the only one. There is another one, but it's still not operating properly. And this falls short significantly from the Commission's initial target of attracting up to 700 billion in assets by 2030. So something is fundamentally wrong if 5 years from now we are very, very far from that. Are you satisfied with the growth of your business until now, and what is your growth strategy under the current circumstances? You have also heard about potential ideas from the Commission that might actually hopefully improve the market. And secondly, what is missing? Really, what would you like to see from the, coming from the EU that would facilitate your business that is missing now and doesn't allow you to excel beyond the markets where you are now? Please.
Oh, thank you. Thank you very much for being here today. So, well, I'm a strong believer in PEP as a product. I really like the product. I think from the very beginning it has been established. I've seen a lot of like a big bright future in this. I think coming back a little to the report, I think PEP is a failure. PEP, wasn't successful. I think what also the report names is that PEP definitely lacks the success because of the tax incentives. I can maybe very shortly, for example, show our data. We're currently live on 4 markets. PEP, on the markets in Poland and Croatia, where the tax incentives are almost at the level playing field, we have a very good penetration among our customers because we not only provide pension product, but also investment products. So in these countries, we have around 45% of penetration. It became our core products, and that just because there are very good tax incentives in those markets. while, for example, in Slovakia, where the tax incentives are very limited, the penetration is only 5%. It's also, I have to admit that the 1% fee cap is a burden for many players, because you need to be technically super good, super effective. You need to be fully digital. You need to have a fully digital distribution, which is eventually quite rare at this moment on the market. And also, there is, I also agree that, the supply, needs to be much enlarged, offering, for example, going more into the occupational direction. Just to let you understand where we are currently now, we have around the report name like 5,000 clients, I think with 30 million. Now we are 13,000 clients, 60 million assets under management. Still not what we expected. And so what needs to be improved, in my opinion? First of all, Savings and Investment Union is to draw more capital into European Union. PEP currently is constructed, in my opinion, in a way that is actually taking the capital out of European Union, because the total expense ratio of the underlyings needs to be included in the fee cap. So if you look at, PEP, our PEP is, for example, constructed out of EDFs. So which ETF has the lowest total expense ratio is the American S&P 500, and not European equities, where fee cap is, with the total expense ratio of 0.3. We can't include any private equity, where private equity funds would have 2% fees. Also, you need to have VAT included in the fee cap. So one country might have a 19% VAT, another country can have 27, like Hungary. So, that leaves you only a room of around 65 basis points for the provider. So you really need to be technical. Also, you need to be able to provide within that fee a distribution. So this is also a huge challenge, because you can't outsource the distribution only having 60 basis points, to share with. Also, when I mentioned when I touched the point that we need to kind of like make it more attractive, so we need to create it as an occupational product. We need to allow employees, to sign on behalf of the employers to sign on behalf of the employees, or probably open up auto enrollment, which would mean abandoning advice, which would mean maybe simplifying the rules on AML. And obviously making tax incentives for the companies, to put such contribution as a tax, as a tax cost. Also, we need to talk about the distribution and marketing. Allowing business referrals, allowing IDD distributors not only to distribute among in insurance sector, but also other different types of PEP providers, like broker providers. We need to allow investment distributors to distribute PEP, obviously through pension dashboard, market this product, or put into put this topic much more in the front. I believe sub-accounts are not needed, and these are, let's say, the most critical things. In terms of, you've been asking about our plans, we are kind of like now in the starting blocks, where we wait how EU and European Commission is thinking about the reform, whether they want to move it really simple, digital, very easy, and remove all the barriers. If so, we would love to do next year another 11 countries, covering already 90% of the inhabitants, and in the EU countries, and really try to grow extremely fast. And also, we are thinking, since we are the only provider with really kind of like good knowledge, we are preparing ourselves to share our software knowledge and offer potential participants, potential players, our software to start offering their own PEP solutions for the client. So this is how we think. We really have big plans, but let's see, where the regulation from the EU gonna look like.
Thank you very much, Juraj. I think you covered both where you are and what you want to do and what you need. So we will come back to you during the Q&A. I'm sure our audience is keen to know more, but thanks for giving really a specific kind of case study in less than 5 minutes about the main parameters of your business. Now, let me come to Mr. Uldis Terps, whom I'm delighted to welcome here. He is CEO of Finance Latvia Association. He's got vast experience in the financial sector. Just to mention that he was the first chair of the newly established financial supervisor in Latvia, if I remember correctly, long time ago. And in the meantime, he worked in financial sectors in Europe and beyond. So I will probably not focus on your thoughts about the report, because we discussed this already at the preparatory stage, but rather really we would like to hear views from Latvia, from the Baltic countries, from the Baltic markets. We have relatively young pension systems, primarily based on pay-as-you-go, as the legacy of the past, so to say. And in these circumstances, where the demography is a major source of concern, sustainability of national finances becomes an issue. Income from pay-as-you-go when retiring might not be adequate, and local markets are not deep enough. What actions would you expect from the European Union to improve the situation, or maybe nothing? Please, Uldis, the floor is yours.
Thank you, Mihails, for a great question, and it's a pleasure to be here. Thank you for that. Also, I think it's very important that the EU Court of Auditors has drafted this report, because this has facilitated thinking not only about your 6 specific recommendations, but more broadly on what has to be done to create more sustainable pension systems and what components they should have. Now, I think Baltics is a very interesting case study, because these are relatively young countries which have started their pension reforms perhaps 25 years ago, and have largely from the outset designed the system in a very correct manner, with the first tier consisting of a pay-as-you-go system, the second tier that consists of mandatory contributions to a system where the funds can be accumulated, and then the third tier, which is consisting of both occupational pensions, but largely private pension contributions and private pension funds. And indeed, if you just take one specific case study of Latvia and look at the kind of where the money is, so the second tier has accumulated something close to 9 billion euros in those 25 years. And the third tier, the voluntary part, where people themselves had to take decisions for their old age, have accumulated just 1 billion. So that comes back to what I think was Matti mentioned on the importance of actually having the correct institutional structure to facilitate long-term savings. Now, what are the concerning parts so much are not related to pan-European products, but it is to ensure that there is a continuity of good policies that facilitate savings. And this is what the current EU Commission proposal for savings and capital markets union is all about, right? How to, through different mechanisms and incentives, create a bigger market and facilitate savings in products which produce higher returns. In this case, I think this is where the real problem is, that the correctly designed pension system has been effectively made worse in 2 of the 3 Baltic states by effectively either already changing the nature of the second-tier pension system in Estonia from mandatory to voluntary, which has resulted into significant fall in assets of the system, and created and exacerbated those concerns about the adequacy of the first tier, or in Lithuania, where similar proposals will be enacted next year. And of course, from a Latvian perspective, we're very concerned about these developments. Because what effectively is happening is that our societies are facing the biggest geopolitical threat that we have seen in the past 30 years. This geopolitical threat is being answered by correct measures of strengthening defense and security. But there is a very big political incentive to strengthen the short-term increase in defense and security spending at the expense of long-term sustainability of the pension system. Because what is happening in those countries who reform the second-tier pension system and dismantle it partly or make it voluntary is that, as people take money out of the system for investments or for consumption, more often for consumption than for investments, the government can tax these proceeds. So effectively, even in a small country, you suddenly have windfall personal income tax, which could be used to plug the budget hole created by increased defense spending. So effectively, you have on the macro level a completely wrong trade-off between your short-term challenges and your long-term sustainability. And this trade-off is made in a way which is not sustainable. So what can we do? I mean, this is, of course, primarily a national problem. I mean, as I think Milton Friedman said, if somebody wants to punch a hole in a boat he's sitting in, I mean, what can you do? But on the other hand, of course, EU has a number of mechanisms, such as already mentioned, the European semester process, through which European Commission could be much more vocal on such short-termist measures which go against both national and EU level long-term policies of facilitating savings on creating a sustainable system. And so far, I'm very optimistic about the things which have been done at a national level, to facilitate savings and especially the second-tier system. It's heavily regulated, but the commissions are capped. They actually are below 1% for those ones who are interested in numbers. So asset management commissions are below 1% in the second tier. There's also automatic enrollment of people in the pension plan, which is corresponding to their age and level of risk. There is also a nudging system created so that pension providers are obliged to contact customers who are not in correct pension plans according to their level of risk. So that younger people are forced into equities or nudged into equities, and older people are nudged into more bond-dominated plans when they reach retirement age. So those all things that have been done so far are correct, but I think there are grave concerns that relate to what I mentioned initially on how countries are facing the existing geopolitical threats by effectively trying to find money in all pockets that they may have. And one of those pockets is unfortunately the second-tier pension system, where governments have the risk of seeing it as effectively a source of additional revenues, where people are incentivized to act in a short-term manner while system is converted from mandatory to a voluntary system and tax those proceeds. And I think that is a very dangerous trend. We have seen that happening in Estonia. It's a very well analyzed phenomena. We know what the effects are. We are now seeing as we speak in Lithuania, and of course we don't want this to be repeated in Latvia. So with that being said, I want to again thank for the opportunity to participate in this very important debate.
Thank you very much for this. You put things very clear. I think the main motive is continuity in policy making at national level that can be supported by the European Union, and that's the answer to also the point Matti made about the need to use multilateral policy tools more effectively. Of course, we all know there is a high competition to include a certain policy area in recommendations of the European semester, where the trend is that we need to be more focused and address the main issues. And now the number of main issues, as you pointed out yourself, has been on the rise since 5 or 10 years. So of course it is also a question for the Commission how to calibrate this. But I agree with you that continuity and support from the EU for this continuity is actually very important and would be helpful. Thank you very much for joining us today. Now I give the floor to Damian to bring us back in terms of time management, because I'm not a very good, as you see, time manager, and Damian is. But we won't like to do it at the expense of the Q&A with the audience, so we will take as much time as possible to address and to allow you, the audience, to interact with the diverse panel of speakers. So Damian, over to you to manage this Q&A.
Thank you very much, Mihails. So indeed, we are just running a little bit late. A little bit means slightly over 20 minutes, but the debate is very engaging, very lively. I think we've heard very much appreciated and actionable insight so far. So, like Mihails said, the floor is now open to any comments you might have for our speakers, any questions you want to pose to us. You can use either the Teams, like Joe did it earlier in the morning, and ask us the question yourself, or you can put it in the Slido and we will read it out for you. You can see the QR code. If you haven't scanned it yet, please do so now. There are plenty of questions still from before. And let me just check if we have any hands raised in Teams. That is not the case. So let's go straight to the most voted questions, at least in the Slido. And I think we've addressed most of them. I've gone through them briefly through the presentations. I think all of them have been touched upon already, but let me just take a few. First one would be from an Anne asking, can EU move any further in developing supplementary pensions without drastic changes in EU regulations or even treaties? And there's another question related to it, basically mentioned whether the EU should then become a fiscal tax or a social union if it stands a chance of doing so. So perhaps maybe Mihails, but I've also heard that Matti and Jacques weighed in on this, so perhaps to them as well.
Maybe go directly to the speakers and
Matti and Jacques. Matti,
whoever wants to contribute,
or anybody else who'd like to contribute to this answer.
Yeah, I'm happy to start, and that is a really good question. I think it goes back to all this when we were, years ago debating the basic treaties. To the question of whether there should be more European competencies to be more social at member state level. It's a fundamental question of what is the right balance in this, but it may well be, but that within the basic existing treaties, these obstacles are really real, and then one has to act within the competencies and within those borderlines, and to change any of this is really challenging. It was really difficult when Europe was, I think, was smaller with less problems than we have today. So it might be inevitable at some point, but when that point is, I don't dare to guess.
That's
really
fair enough.
Important issue.
That's fair enough. Matti, thank you very much. Jacques, and I think Petra also raised her hand. I think Petra and Jacques, perhaps.
Well, I'll do it very quickly prior to Petra. I'd like to echo what Matti said. I think we should pay respect to the widely diversified landscape that we developed over centuries, at least last decades. Out of local context perspective, respect that. But I think the aim of having more funded pensions out of a social perspective, but also out of a capital market perspective, we deal with 40 to 50 basis points annual growth by having such an underdeveloped capital market. Is ample opportunity for the Commission to push more and use whatever is in the toolkit. Petra.
Yes, and maybe before I answer this particular one, I see a question in the chat from someone who says, but then if Mr. Kozlovs is telling his kids that there won't be any retirement money or don't count on your state pension, isn't that a horrible idea? But the thing is, I'm a Dutch national, and I've been raised by my parents with you will get a pension from the state, but it won't be enough to get you through your entire retirement. You need to do something in addition, and that didn't end the world for me, and neither did it for my kids today. So yes, I do think that we need to make sure that that people to a certain extent realize they need to do something additional, but I'm not naive that they will then do something. So I don't think it's people that will incentivize governments to do something, because pensions is a very difficult topic to get people to think about. So here we have a responsibility to make people think about that, or to nudge people to do something. Here automatic enrollment, for example, helps. So when we work on this, and I'm also mindful that the people today in the call very much come from countries that have already a well-established pension system, but we have an overview of the rest of Europe, and had the Commission, DG Employ says it very well. I mean, there's whole parts of Europe where there is no Pillar 2 or Pillar 3. There's hardly any. And meanwhile, every country wants to solve it alone. But the reality is that if indeed we only have 1.3 on average people working for every pensioner, state pensions are not sustainable. If we don't fix something in the second and the third pillar, that is a problem. And that ultimately will be Europe's problem, because that goes back to that goes to the budgets of states, that has an impact on EU. So here is where very local pension thinking comes together with a European view on our finances long term in the future. So I appreciate an industry that says we're very different and don't touch anything, but you could nudge some others. Maybe that is also not enough. So concrete steps, this dashboard and this pension tracking system, and we've been advising already on this for many years, which requires strong cooperation between DG Employment and DG FISMA, and also with me, with others, but providing an overview not only to individuals in a pension tracking system, but also to states in a dashboard on where they are on their pension savings. But moreover, and I find the second step much more important than the first, we all have a problem, so I don't need to show problems. I need to think about solutions. If you have a dashboard and you want to spend public money on helping better saving for retirement, then on the basis of the dashboard, you can think, am I going to incentivize Pillar 2? Am I going to incentivize Pillar 3? Or am I going to continue to pay into Pillar 1? And I think this you can only do if you take a holistic view. We need to bring that together, and we need to realize that customers, members, beneficiaries, policyholders, they're not that interested. They need to be nudged. And then we need to learn from each other, but we also, I think, need to create the urgency, because it is urgent. Finally, on a European level, our Eurobarometer survey among citizens in EU showed that almost half of European citizens would save better and more for retirement if they could do it in something that's European, because somehow they trust that better. Hence our idea for this label for Europension. So I think we can still do a lot at European level. We need to start from a conscious national framework and do that consciously, but we shouldn't stop there. And we should focus on all citizens, and then I'll stop. There was a big focus on people who work cross-border. That's 12 million members. But if you look at everyone in the EU that needs a pension, that is a multiple of that. So let's first start with better pensions, and let's then indeed also make sure we can do it cross-border. But I think the urgency is with the larger group, and that is also national. And I'll stop there. Thank you.
Well, thank you very much, Petra, also to Jacques and Matti. I think we can move on teams now. I've seen one hand raised from Massimo Suardi, I think Director of the European Commission. Massimo, if you're still with us, then the floor is yours.
Oh, hi. Yes, I'm still with you, and well, thanks for the very interesting conference. Now, unless I missed it, I haven't heard anybody commenting on one of the findings that was in the report, and it was also, I think, in the slides that you have showed, that it was the relatively low return of these schemes, which I think, in terms of promoting them to the wider public, is something that, of course, is not great in the way it comes out from here. On the other hand, I mean, I'm not an expert, and perhaps there are good reasons why at least at the aggregate level, the performance doesn't look great. But I was wondering whether anybody, especially any of the practitioners, would have a comment about that.
Thank you very much, Jacques. Great to see you with us. So I think you asked our practitioners if they had anything to say about that. So I'm looking at Uldis, Juraj, and perhaps Jacques and Matti as well.
Juraj, I think. Raised hand.
Shall I start?
Yes, please. We just have maybe just a couple of more minutes if we want to stick relatively close to time.
I think this is a very important question and a very one of the most relevant. I think one of the most relevant questions you can ask. I was a bit astonished by the figures presented in the report. It comes back to basics. Whenever you want to enter into a good pension environment, first you need this premium payment. That has been discussed extensively, I think. Next thing you have to do, I refer to the pension triangle, so the next angle is taking a risk. And if you take appropriate risk, you get a good return. And so good risk taking and having good returns is vital. If I take a look into the Dutch landscape, what you see pension funds do is appropriate risk taking in order to get returns and get good pensions. Here at SPMS, we are very close to realizing real returns matching inflation. We can only do that by appropriate risk taking. But you should all take in mind, we should probably take a bit better look. We invest up to the liabilities. And liabilities are very, very long. So taking just a nominal approach and taking a look at returns is probably not rendering the right picture.
Okay, thank you very much. Anybody else from our speakers that would like to weigh in on this? Yes, Petra, and I think Uldis. Uldis.
Very brief, because in the interest of time, but there's reports out there. If we look if we look at pension funds, EIOPs, then not every market is already as transparent about cost as, for example, the Dutch market is. And transparency will help to monitor cost, and then you can always explain the cost. So we've seen really an impact on cost in a positive way once that market became transparent. Not every market yet is. We have advice on that as EIOPA. We think that would really benefit the returns if you become much more transparent on the cost of EIOPs. On the other pension products and the third pillar, there's multiple studies of us that show that at least for the investment-based, insurance-based investment products, around 15% don't deliver any value for money. So people pay more than they get. It's 15%, it's way too much. But still, those who do provide value for money in the sense that people get a return, their return does not compensate for inflation. And yes, inflation was high, but it doesn't. So I fully agree with Valdis that this is a concern, and with the findings in the report, this is a concern, and this is why value for money is so essential. I'm not talking about a cost cap, but I talk about a price that is a fair reflection of returns, of the cost made and of the services provided. And in general, we do see that if consumers choose for a bit higher risk, they will have a better return. And that's where they need advice, they need help. They tend to choose for the mid risk. It has to be a life cycle product, but when you're young, you can take risk. But you need to have some advice, you need to have some guidance, but you also need to get their value for money. And I'll stop there.
Value for money, definitely something that we constantly profess. Uldis, any final thoughts on this question?
Yes, just very shortly. I'll give you an empirical example from the latest OECD. In Latvia, 20-year average return is 2.5%. And it is much lower than perhaps you would expect, but it's largely a function of the fact that when the pension reform was started, you had a cap on how much you can invest in equities. And this is a direct result of incorrectly designed policies. So if you look at this at the same time of returns on, let's say, 5-year return on a high risk fund, which is appropriate for most young and mid-aged people, you basically see it's 11% per annum. So in non-inflation adjusted terms. So that underscores how important it is, A, to design the system in a proper manner, and B, to make sure that people actually are investing in funds which are corresponding to their recommended level of risk, so that they are not under risking their investments. Thank you.
Excellent, and I think we have time for one more question. Bjark from Politico. Bjark, are you with us?
Hi. Yes, I'm here. Thank you so much, Damien. I got two questions, one for EIOPA and the other one for the Commission. The first one, just for the Commission, I think PensionsEurope also mentioned the idea that we should use country-specific recommendations as a way to encourage national reforms on pensions. And if the MFF idea of which say cash for reforms principle works out, that probably would add a little bit of teeth to this. So I'd like to know from the Commission, is it the Commission's intention to use country-specific recommendations to enforce pension reform? And then to EIOPA, I hear you on the label and the tax breaks. The closest thing we have to this is through the Competitiveness Lab. I understand that the countries that are grouping together are working on something like this, but key to this label is that the investment vehicle mainly puts most of the money in Europe. I'm just wondering if you agree with the idea that such a label should mainly invest in Europe. Thank you.
Thank you very much. So that was Bjark Smith-Meyer from the media Politico, and he often writes about this pressing topic. So I think first the question to Petra and then to Franck.
Yeah, thank you for the question. What you're asking me is how does the Euro pension, the basic PEP, relates to the Euro Invest label that is developed by a coalition of the willing. They are compatible, they can exist together, they can also exist without each other, they are definitely not the same. The Euro pension is a set of criteria that you need to fulfill that sends a strong signal to the consumer that they are buying a product that will give them value for money, that has a fair price, and that is well supervised. So it somehow gives a signal, if you want to save in a third pillar, you can do that in this product, your employers can put it in this product, and you will get a good pension. And that is where it stops. It doesn't say anything on where money should be invested. The idea of the Euro Invest label is a different signal. It signals that if you save in our product, in this particular product, then at least 75% of what is invested will be reinvested in the European Union and not outside of the European Union. Currently, 3 trillion in assets in the European pension systems, over 50% not invested in EU because it needs to find a return. It's diversified also outside of EU. But if you have a Euro Invest label, at least 75%, that is at least the plan now, should be invested. So in future, you could see a product that is a Euro pension with all the features for safe retirement savings that also has a Euro Invest label and just signals we're investing it in Europe. Whether or not they do that is not for the supervisors. Supervisors do not advise where to invest. We will leave that to the portfolio managers of industry. I think they do a much better job. Having said that, if there are good propositions that are bankable in EU, I'm told by my industry that they are happy to bring more capital to EU, but they need to get their proposals. And I hope, and I think I know, that there's a lot of thinking on what needs to happen in the EU market to make these investment proposals happen and get more investment back into EU. And I'll stop there.
Thank you, Petra. And now maybe Franck for the second question.
Yes, thank you very much, Damien. It is true that the country-specific recommendations last semester were tackling pension issues in 10 cases. But as one speaker said previously, none of these were about the second and third pillar. It was very much about the sustainability and adequacy of the first pillar. So I do not know what ECFIN is thinking concretely in that regard, and whether they would consider to move into this direction. I would personally think that this would be quite helpful, as we've seen in this debate, and this is certainly a point from this debate to bring back to our colleagues in charge in DG ECFIN. I just would like to come back very quickly to the previous question, if you allow. Very quickly, we spoke about the legislation. We've discussed today about the complexity of this area and the difficulty which the Commission is facing for its proposal towards the end of this year. As DG Employment, I just want also to say that the pension issues is also very much in the hands of the member states, and we've seen with the European Pillar of Social Rights that when member states sit together, they can also fix clear principles and clear objectives. As the minister said, if there is will, there is a way. So I think that beyond legislation, which is absolutely crucial, which has to be as simple as possible, should not bring complexity, we should look also into the pillar and the dialogue between member states to progress in this area. Thank you.
Thank you very much, Frank, and surely Bjark, if he needs any follow-up, knows where to find both of you or representatives of your institutions. So thank you very much. Also, Bjark, for your question. This is not a press conference, but we're very happy that also media takes interest in this topic and the conference that we have organized today. So I think on this note, well, it's 12 o'clock. Normally we should have stopped, but we still, I think, have speakers with us. We still have Mihails and Camilla here. So I think, Mihails, you still have plan to ask something to our speakers.
Yes, we are a bit beyond the scheduled, colleagues, but I think the discussion is interesting. So now I see that we all realize the risk posed by unsustainable pension systems, and we all agree that supplementary pensions could strengthen financial markets in the EU, help alleviate fiscal pressure, and address social concerns. And some of us have different perspective of what comes first, what comes second, and what comes third. And I think this is part of the difficulties that also the Commission will face to really make sure that the proposals address these matters in a holistic approach as far as possible, of course, within the current remit of the EU. I just would like to ask again all our speakers one by one, but really keep it please within 1 minute. What would you see as an immediate, because I say an immediate because I don't think we have time for many, an immediate step for the EU to take to boost the second and the third pillar? Like one step, it might not be the only one, but what for you, if you were given the reins, so to say, what would you put on paper for the legislators at the end of the year? We may start maybe in the similar order as Petra then comes first.
Okay, my sentence, there's a lot I want, but then let me focus. I would love to have a very clear mandate going to DG Employment, FISMA, and I stand ready to support to build a pension dashboard that includes the first, the second, and the third pillar for every EU member state to help them identify how they best can reform their market to develop the three pillar systems in a way that fits into the culture and the law that they have. Thank you.
Thank you, Petra. Then Franck is the next one, please.
Thank you very much. I think that Commissioner Albuquerque and the DG ECFIN are working very much on this proposal for the pension package towards the end of the year, and with the help of Emploi, but also the good contribution by EIOPA and other stakeholders. I think the work is very complex and complicated. I would like to insist on the need to boost transparency and trust. I fully agree with Petra. This is crucial, and we're working together there. We have a pension dashboard. to follow the evolution of pension coverage across member states in a comprehensive manner. With the aging and pension report, we have already a good basis for the first pillar, but I fully agree with Petra that we need to integrate now and take some steps forward to complete the picture with the privately provided occupational and pension reforms, and we're working together in this area. Thank you.
Thank you, Frank. Looking forward to the Commission's proposal, of course, towards the end of the year. Next is Matti, please. Your silver bullet.
I would echo the previous speakers, and also to add that the EU should encourage member states to extend coverage, also very much using auto-enrollment where that is feasible and necessary and useful, but keeping rules proportionate and respecting the social partner governance. And in addition, I think it's really important that all the different relevant parts of the Commission work in good cooperation with EIOPA and other stakeholders as well. And I was really encouraged to see the work that the Commission did last year with the workshops, where we really could see the complexity of the whole topic and the necessity to have this comprehensive view on pensions and working together and not in silos.
Thank you. A very clear call for auto-enrollment, I think, from Matti. Jacques, you have many ideas, I'm sure, but just give us the most important in your eyes.
I'll be quick. 3 lines. First, the EU can be more ambitious to nudge member states in growing funded pensions. The use of conditionality in EU funding is a route. Second, the IR2 reform, I think a targeted update is welcome. However, we must make sure the framework stays proportionate and minimum harmonized. Otherwise, you might discourage social partners or employers from starting to provide occupational pensions. Third, grow the EU capital market. I should have started with this. I think the US capital market is 6 times bigger than ours, where the EU is the largest consumer market of the world. That should change. Funded pensions support flourishing capital markets also by adequate risk-taking. No good pensions without proper risk-taking. No good capital markets without pensions. But not by mandatory forcing pension funds to invest in the EU. Grow pensions.
Thank you. That's very optimistic. Grow pensions. Good call. Now, Juraj, over to you. We just realized that apparently around these days, your PEP will celebrate 3 years since establishment. So what birthday present could the institutions offer to you towards the end of the year?
So I think in order what to do, I think EIOPA, OPSG, and also European Commission name it in its consultation paper. I think if those measures will be taken, it will be a blessing for European pension. And as you said, today actually is exactly 3 years since the first rollout of PEP in EU. And I have to say, I was among the first clients at that day, and my return over the 3-year period is 49%. So saying that, I see it very optimistic that if pensions will have such returns, and we will be able to change these legacy schemes into more productive capital, I think everybody will be benefiting this. Thank you.
Thank you for this encouraging statement. And then, last but not the least, Uldis, over to you.
Well, thanks. It's difficult to come up with additional things after a list of so great proposals, but I would dare to have two remarks. First, in the line with what has been already said about conditionality of EU funds, I would say maybe we should contemplate harder measures against countries that regress in the development of their pension systems. And we have examples of countries who regress in the development of their pension systems, and maybe that should have consequences. That's the idea number one. The idea number two is do not hinder healthy risk-taking. Ideas that give tax benefits to investments only in Europe are hindering asset diversification and are hindering healthy risk-taking. So please think very hard about what stimulus are being used. A bigger EU capital market is a necessity, but growing it by non-market means is a very doubtful proposition. Thank you.
Thank you, Ulrich, very much. Thanks again to all of the participants and speakers today. I think it's time to close this event. I think we more or less agree, all of us, that there is a way for the EU to develop third and second pillar in the future. So there is a role for the EU, and perhaps this role should increase, and we are looking forward again, as I said, to the Commission's proposals. We are looking forward to the annual cycles of EU semester and the discussion on conditionality for the EU funds in the future, although now we all know that we focus more on concepts like rule of law. But I think we can be optimistic, and from the past we have seen that major crisis came because some member states, some governments were too complacent for too long, and perhaps from the EU institutions there was not enough actions to make sure things are on the right path. So I think it's good we all agree to address this issue holistically, from the fiscal side, fiscal sustainability side, from the social side, because we have a European pillar of social rights where adequacy of income post-retirement is one of the principles, through decent life idea post-retirement. And last but not the least, the third angle is, of course, the financial markets, whereby we have seen what can be done, what is the market structure, how to improve the motivation for citizens to, first of all, get interested, but also to invest. And last but not the least, that the returns can be higher if the risks are managed in the right way. So, colleagues, participants, again, thank you very much, and don't hesitate to contact again the homepage of the Court of Auditors. We have plenty of other reports, interesting reports in the field of economic and financial governance and beyond. So feel free to contact us or our communication teams. I thank also everybody who was involved in the preparation here in the studio, but also beyond, colleagues from my office, colleagues from the audit team who did a great job, colleagues from the communication team, and Damian for keeping us now only 12 minutes beyond schedule. So we squeezed from 20 to 12 minutes beyond schedule, and therefore I say thank you to Damian and give the floor to him to formally disconnect us from live broadcast.
Well, I would like to thank you very much, Mihails, for giving us such a not only succinct but very comprehensive overview of our report, but also of the broader topic. To you, Camilla, for helping out with all the details from our audit, and to all the speakers who were with us, providing various angles of insight, and also to all the participants. I think there are still almost 150 of you who are following. Now, if you have missed any parts of today's session, we will send you the recording of it in full HD, and we will also keep an eye on the topic as it develops. It's still work in progress, but formally speaking, as Mihail said, the word formal, in 3 years from now, we will also look how our recommendations from the report will be implemented by the auditee. So get in touch with us. I think we've answered most of the questions on Slido through the presentations. If you feel any of those hasn't been addressed, please do not hesitate to get in touch with us or any of the speakers indeed. Thank you very much from my side as well.